David, thanks for coming in to speak with Matt and I and the rest of our colleagues. What does this mean for the U.S. economy? How many points in GDP are we talking about here if we miss this August 2nd deadline?
Well, I think missing August 2nd is not necessarily a big deal. It looks to me like that's going to happen. We're not going to get it done by August 2nd. It is going to happen. I don't think it's going to happen by August 2nd, and not the way things, the math and all this political dynamic is playing out. As a matter of fact, we have not believed that we thought it was a 50-50 chance 2 weeks ago that we'd miss the August 2nd deadline. Frankly, I think the real deadline seems to me to be the day they leave for recess. That's been pushed back a week, which is now August 12th.
And we can make it that long without defaulting?
I don't know. I mean, well, we can make it that long without defaulting. We can make it a whole year without defaulting.
And paying Social Security and keeping national parks open, etc.
Well, not everything open. We got roughly $2.5 trillion of spending, and we've got $1.5 trillion of funding. So we got well, it's a little bit more than that. More
so
like
you're talking about taxes,
so
the pool being higher than we thought.
The pool is higher than the pool that we'll have in August is not going to be sufficient to cover all the bills in August by the end of the month. It will be more than sufficient to pay interest on the debt. It will always, I think, every month be more than sufficient. The month-end balance, anyway, would be. So that means the Treasury would have to hoard cash in order to pay the debt off when it comes due on usually the 15th and the last day of the month, either the 30th or 31st. And it would need to do that on an ongoing, rolling basis. And it can also reissue debt that's already outstanding. So it's got sufficient funds to avoid a default on debt. Now, there is a high probability, if they don't get to, say, August 5th with something done, that there will be not enough funds to meet all of the government's bills, but those have different legal status, say, than debt has.
Bottom line, you don't think there's going to be a default. You think there will be a decision by the time they go on recess, August 12th. Juliana Goldman out in Washington has a question. Let's bring her in here. Juliana?
Thanks, Matt. Well, it's not just the default, but what about a ratings downgrade? I mean, we're hearing even here in Washington that S&P could downgrade U.S. credit as early as this week, not even waiting until that August 2nd deadline. What reaction would we see there? And is there a sense that that might be what lawmakers need to sort of scare them into submission to getting some sort of deal?
Well, some people believe that a downgrade would scare Washington into quicker action, and maybe that's what maybe S&P's strategy here was to help speed the process along by threatening a downgrade. But the underlying dynamics of the U.S. long-run fiscal outlook haven't changed much in the last month, 2 months, 6 months. The one thing that probably has changed is we've elevated the awareness of the general public about what the problems we face in the long run. To me, that's a good thing. That means that we're going to address these issues in one fashion or another in a way that reduces our debt exposure over the next decade. And to me, that means that our credit standing is probably healthier because we brought this stuff to public awareness in a very big way over the last 6 months. So does that mean that U.S. credit conditions are worse? Is the U.S. credit standing really worse? Not in my judgment. I think it's probably better. But S&P's backed itself into a bit of a box. It said it needed a $4 trillion deal. It's not going to get a $4 trillion deal. So does it put its own credibility on the line and not downgrade the U.S.? Whatever their view of the U.S. long-run fiscal position is, I don't see why it would be likely to have changed because of this. Unless they believe the politicians in Washington will default on debt, as opposed to...
But you're saying, in your view, as an economist, that's highly unlikely.
Look, the math's pretty simple. We collect $1.5 trillion of revenues. We have about $300+ billion in interest obligations. That's a coverage of 5 times. Now, we don't have enough to pay all the other bills that we've incurred. We wouldn't have enough to pay. We probably have enough to pay over the course of the year. All Social Security beneficiaries, probably all Medicare beneficiaries.
But it sounds like you're saying, look, this is symbolic. This is symbolic. It's, in fact, probably why the markets are not reacting as if there is imminent catastrophe.
Yeah, but there is. I'm not saying there's not a catastrophe of a different sort awaiting. If we don't allow the government to fund its operations, then there will be an enormous hit to the U.S. economy. Defense contractors won't get paid. they'll start laying off workers. Military personnel might not get paid. There are real consequences of not getting a debt ceiling done. Very real consequences. Now, we could go probably a few days with delayed payments and things like that. But if it extends much beyond, say, 10 days, it would be very real in its effect. And in fact, it may already be having an effect because the uncertainty about what lies ahead in the next month or so is affecting businesses' decisions.
We're back with David Resler, chief U.S. economist at Nomura Securities. He's one of the most accurate forecasters in 5 different categories of economic data, making him a Bloomberg best all over the place. So congratulations on that. Thanks for joining us. Well, obviously, we're focused on the debt debate, on the debt ceiling debate. And you point out Bull Simpson had so much support, and that was the president's own commission, and then he dissed it. Why?
Baffles me. I mean, I think if we'd had a debate all year, instead of about just raising the debt ceiling, about Bull Simpson, we'd be a lot closer to a bipartisan agreement right now, and probably closer to a serious resolution of the debt. And I don't think that
one with more cuts, one with
we
revenue.
Wouldn't be facing a debt rating downgrade either.
Let's talk about what happens going forward. You had thought the Boehner plan looked more likely to pass than the Reid plan. It's taken some heat since you thought that last night. But there is still a Boehner plan out there that's kind of floating in purgatory right now, and that's cut, cap, and balance, which the Democrats see as a joke. But the Republicans say, hey, look, we got it passed through the Congress, through the House.
And in fact, last night when we were writing this report, just before we sent it out, the CBO had issued a report on the cut, cap, and balance plan and scored that, I think, at about a $1.2 trillion savings over 10 years. We sent out the report where we thought this current Boehner plan would be the most likely to form the foundation for something that got
scored where
passed.
relative to that?
Well, relative to that, it was supposedly a $1 trillion plan. But CBO, about 20 minutes after we put out our report, came out and said, no, it's only 850. So, in fact, I just learned that about an hour ago when I woke up. And this means that the current Boehner plan needs to be modified significantly if it's going to pass.
Bottom line, there are a lot of plans out there. All of them need a lot of work. You don't think anything's happening by August 2nd, but you also don't think they'll let us default. Right.
I think there's close to zero chance that we actually default on the debt, but there's an increasingly high probability that we don't get this done by August 2nd, and that means that we face a growing risk that there'll be some disruption of normal government operations, and that's going to be costly to the economy.
And a downgrade.
And a downgrade, I think, is probably likely, at least that either S&P follows through on what it said it would do if it's not a $4 trillion plan, because it's not going to be $4 trillion, it looks like, and downgrades the U.S., or it loses some credibility.
All right. Hey, David, thanks so much for joining us. It's been a pleasure having you. David Resler from Nomura Securities.